Hello everyone. Mini Professor Olivier is back again. Are you ready for a new weekly analysis of financial markets? If you enjoy this weekly video, please show me your support and like it below, you will make my day. So, let's start. Shares have been on a roller coaster ride since the presidential election. The contested, and closer than expected vote, was quickly followed by last week's early vaccine hopes, to provide investors with plenty of both good and bad news to focus on. The good news is that this two-way pull seems to be resolving itself positively for now. Markets are hitting new highs again, after a couple of months in the doldrums. This new optimistic outlook is also showing up in increased M&A activity. Just this week, nearly $40 billion of deals have been announced, as companies look to take advantage of more political stability, and still cheap funding. Yesterday the U.S. operations of Spanish bank BBVA were sold to Pittsburgh-based PNC, for $12 billion. Home Depot expanded with a $9 billion purchase of HD Supply. And there was a string of smaller deals too. On the political front, we are in limbo for the next few weeks. Although the White House looks to be safe for Joe Biden now, the current president is yet to concede, and legal challenges continue, albeit with little or no success so far. The more interesting question continues to be whether the Senate will stay Republican, or swing to the Democrats, and for that answer we will have to wait until January. That's when a runoff will decide 2 Senate seats in Georgia. At the moment, these are the dividing line between a small Republican majority and an evenly divided Senate, subject to the vice president's deciding vote. The ability of the next president to push through his tax and spend agenda will be seriously curtailed by a hostile Senate. And as fiscal stimulus has been a key part of the bull case for shares, that matters a lot to investors. The good news, however, is that a return to normality may be closer than hoped for despite, in the short run, the COVID situation getting worse rather than better. The markets being a discounting mechanism, they are looking through the rise in infections to a brighter picture in 2021. The good news on the vaccine front was given a further boost this week, after a potential jab from U.S. biotech Moderna showed a 94.5% efficacy rate in clinical trials. That beat even the 90% positive score for the Pfizer vaccine announced a week ago. The Moderna jab also looks more practical than Pfizer's, being able to be transported and stored at less extremely low temperatures. Shares moved higher on the latest good medical news, with the European market closing 1.6% higher yesterday, and shares in New York rising 1.2%. The S&P 500 had already pushed forward to a new all-time high last week, on the back of this renewed optimism, and nearly 3/4 of America's leading stocks made a new 4-week high in recent days. From a technical point of view, the sideways moving volatility since September seems to be resolving itself, by reverting to the previous uptrend. The upward momentum is being driven by a recovery in the so-called reopening stocks. These are the shares in bombed-out areas like hospitality, retail and travel, that need a return to normality to get back on their feet. The good news is that the bounce back in these areas is not really at the expense of the previous winners in technology and healthcare. They are outperforming relatively, but the recovery is broadening out at the same time, a good sign. It's not before time. Over the past decade, growth stocks have risen by 225%, compared with just 88% for the value index. This year has seen that trend accelerate, with growth stocks up 25%, while value has fallen 7%. This is reflected in valuations, with growth stocks now trading on 38 times earnings, while value stocks are on a PE of just 17. That gap is even wider than during the dot-com boom. It's not just styles that are pointing to a rotation. The size effect is important too. Smaller companies are starting to outperform larger ones. And that is typical at the start of a bull market. In some ways, the market is looking more and more like it did in 2009, when the post-financial crisis rally began. To keep that momentum going, company earnings are going to need to continue rising, as they have through the better-than-expected third-quarter earnings season. 6 months ago, the average earnings expectation for the U.S. market was $120 per share. Today it is $132, and $163 has been penciled in for 2021. In time, that will bring down the valuation multiple of the market, and justify prices rising from here. This is the difficult time for investors in the cycle. After the pain of a big market fall, it can be hard to believe that a market now hitting new highs can continue to rise. In Europe, the focus is less on the market, and more on Brexit, with negotiations heading towards the wire against a backdrop of civil war in Downing Street. There is a lot more to worry about on this side of the Atlantic than in the US right now. The Brexit talks are in the final straight this week, with both sides accepting that if a deal is to be done in time for ratification, before the end of the year, then it needs to be thrashed out this week or early next week, at the latest. The crucial sticking points remain fishing rights in British waters, level playing field conditions for business, and enforcement arrangements for these. On Thursday, a video conference of EU leaders stands as the first real deadline this week. Brexit is not technically on the agenda, but it could be added. If there is no progress by then, all is not lost, but time is definitely running out. The European Parliament has penciled in a vote for its final session of the year, on December 14th. But for documents to be prepared for that session, an agreement would really need to be in place by now. It's all very tight. On the corporate front, this week sees the last few announcements in the third quarter earnings season, which has gone much better than many expected. The sector focus this week is very much retail, with a string of results on both sides of the Atlantic. In the U.S., we will hear from Target, Macy's, Walmart, and Home Depot. There's a sprinkling of important economic data too. Yesterday's highlights included retail sales in China, which grew at their fastest rate this year in October. Sales were 4.3% higher, better than the 3.3% rise in September. Despite this, sales for the first 10 months of the year were still 5.9% down on last year. Also out yesterday was Japan's GDP, which rose by 5% in the third quarter, beating expectations of a 4.4% rise. However, Asia's largest developed economy is still 6% smaller than it was a year ago, suggesting that recovery will be long and difficult. The recovery in Asia was given a further boost yesterday, as 15 countries signed a trade pact. Shares across the region rose, even before the good news on the vaccine front yesterday. The region is also enjoying the prospect of a more measured relationship with the U.S. under President Biden than has been the case over the past 4 years. In other markets, the oil price also rose usefully as prospects of a return to normality improved. Brent rose above $43, as oil joined in the rally in all risk assets. That's all for this week. I hope you found this markets update useful. Please don't forget to like it below, and you'll make my day. Thank you very much again. I wish you all an amazing week. Goodbye.